Most beginners think the best strategy during a market crash is to wait for the perfect bottom. But the truth is, nobody knows the exact bottom. And because of the ongoing Middle East tensions, global uncertainty is creating sharp volatility in the stock market again. This video is only for educational purposes and not financial or investment advice. Please do your own research before investing. So instead of trying to predict every move, smart investors focus on building a deployment strategy, a system that helps them invest gradually as markets fall. In this video, let's discuss one simple bearish market investing strategy beginners can understand easily, dividing capital into 4 parts and deploying it step by step based on index correction levels. First, understand this clearly. Never invest your entire cash amount in one shot during uncertain markets. Bear markets often fall in phases. A market that is down 10% today can easily fall 20% later if global conditions worsen. That is why staggered investing becomes important. It reduces emotional pressure and gives flexibility if markets continue correcting. Let's assume you have 1 lakh rupees planned for long-term investing. Instead of deploying all 1 lakh immediately, divide it into 4 parts. The first 10% allocation should be invested when the index corrects around 8 to 10% from recent highs. This is your early entry phase. At this stage, markets are weak, but panic is usually not extreme yet. You are simply starting exposure slowly instead of waiting endlessly. The second allocation, 20% of capital, can be deployed if the index corrects around 15% from highs. This is usually where fear starts increasing in the market. News becomes more negative, volatility rises, and many weak hands begin exiting positions. The third allocation, 30% of capital, can be invested if markets correct around 20 to 25%. Historically, this zone is where broader panic becomes visible. Many quality stocks start trading at more reasonable valuations compared to euphoric market phases. Finally, keep the last 40% capital reserved for deeper corrections, around 30% or more from the peak. This final allocation is important because deep market corrections often create the best long-term opportunities. Now, this does not mean markets cannot fall further. They absolutely can. But the idea is to gradually improve your average buying price instead of gambling everything at one level. This strategy also works because capital deployment increases as valuation attractiveness improves. You invest smaller amounts early and larger amounts when markets become cheaper. One important thing, this strategy works best for long-term investing, not short-term trading. Focus on fundamentally strong businesses, diversified mutual funds, or ETFs instead of random speculative stocks. Avoid buying weak companies just because prices have fallen sharply. In bear markets, quality matters even more. Another smart approach is combining this strategy with monthly SIP investing. Your SIP continues automatically while extra cash gets deployed during larger corrections. This creates both consistency and flexibility at the same time. Also remember that index correction percentages are guides, not exact numbers. Markets move unpredictably. The goal is disciplined allocation, not perfect precision. And before investing aggressively, make sure you already have an emergency fund. Money needed within the next few months should not be exposed to high market volatility. Also avoid leverage or borrowed money during uncertain markets linked to global conflict. Volatility becomes dangerous when debt is involved. The biggest advantage of a phased deployment strategy is simple. It removes the pressure of predicting the perfect bottom. Because investing success usually comes more from discipline than prediction. So during the current bearish market caused by global uncertainty and Middle East tensions, think like a long-term investor. Divide capital wisely, deploy gradually, focus on quality, and stay patient. Markets may remain volatile in the short term, but disciplined investing during fearful periods has historically rewarded patient investors over long time horizons. If you found this video helpful, then do like the video and subscribe to the channel for more practical stock market education for retail investors. And as always, invest responsibly and think long-term. This video is only for educational purposes and not financial or investment advice. Please do your own research before investing.